Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Warren Rogers of Downing Ventures to talk about the Downing One VCT. Hello, Warren.
Hello.
First off, tell me about Downing and also your own experience.
Downing is one of the longest tenured VCT managers, starting in about 1986. Downing itself is about £1 billion under management, with about 160 sterling in VCT assets. We have a range of products: public equity, private equity, such as our energy and infrastructure, and then ventures where I sit. My career started in investment banking. Later I was in trading, and used some of the intellectual property I built to, I was a founder, created a company that focused on trading technology development, risk management, connectivity. That led me to become a founder again. I was a founding general partner of a deep tech focused VC based in Austin, Texas, where I'm from, and also here in London. At the same time, I was a ventures partner with Airbus Defence and Space, focusing on frontier technologies.
Tell me, what is the aim of the Downing One VCT? What does it do for investors?
Well, it provides a fairly stable 4% dividend. It's a diversified product that has our variety of different businesses in there, from private equity to our public equity team, and of course our ventures. So you have a well-diversified product base. You have an excellent team managing this with a lot of flexibility going forward.
And what type of companies are you looking for? What are the characteristics?
The common characteristics for Downing Ventures are, we're looking at companies that fit into the law of big numbers. So we're looking for global opportunities. We're looking for investment opportunities that address a market that is far larger than, say, a local value proposition. We're looking there, again, for some quantifiable measure of intellectual property that can be well-reasoned, it can be proven, can be benchmarked. And further, we're looking for a founder who has those distinctive characteristics that you would find, that you would want to invest with. Maybe a second-time founder, third-time founder, someone with prior experience, somebody from industry. And then we look holistically at the company as a whole. How do we assume it's going to scale? How do we assume that the team is going to change over time? How do we assume their capital needs and a variety of other factors we're working to quantify before we invest.
And can you give me some examples of recent investments that Downing One has made?
Sure. Well, from the ventures team, we recently invested in a company called Parsable, which is an industrial workflow software company that aims to solve a lot of the digitization challenges of the deskless workers. So when we talk about the law of big numbers, their potential audience is about 5.5 billion workers, where their software takes all of the manual tasks from, say, cleaning the restroom at a Starbucks, replacing that clipboard with an automated set of instructions or videos, to perhaps you're working a nuclear reactor. Far more complicated materials, but getting rid of these binders and papers and messy workflow. It addresses a lot of generational change in the marketplace as many of the factory workers start to retire and more younger talent comes in. It's a very interesting business here in the UK that they are in 130 different countries. There are platforms in 120 different languages, and they have added some material jobs here in the UK. It's a very exciting time to be investing in that.
And have you got any other examples of recent investments?
Yes, certainly. Very recently, we were proud to be a lead investor for Cornelis Networks, which is a high-performance interconnect company, which is that is the, we'll call it the pipes that make high-performance servers, supercomputing work, deliver information more quickly. It was a very interesting opportunity. They're well-known here in the UK. They deal with some of the most beloved institutions, from government to universities. It's one of the most wonderful teams to invest with, where they're quite possibly responsible for developing the technology in the first place that they've stewarded then throughout their careers.
And how's Downing One companies, how's coronavirus treated you?
Well, I think it was a very tough time at the outset. There was a lot of lack of information, lack of precedent on really how to structure. I think it turned out to be a positive in the light that it led us to look very carefully at a company's financial projections, at their burn rates, at how they manage their capital going forward, and we were able to affect a lot of change that have much more benefit now going forward. So, of course, we did take we did have some momentary losses there, but we're pleased to say that many of these have recovered very nicely, that the market has started to normalize.
What do you view as the opportunities going forward?
I'm not necessarily the most optimistic. I think I'm a bit sarcastic sometimes and a bit, more, I think more risk awareness. But right now I see almost nothing but opportunity. And I think that, it's multifaceted because we're coming out of or in the middle of an unprecedented time globally. And anyone who's familiar with financial investing lore, understands that this is a time to invest. This is a time to do your homework, to do your research, to pick these areas that will pay off in the future, that fit all manner of the VCT, from the more income generative businesses to what I do in ventures, because now the playing field is somewhat more level. That you have many very decent companies seeking their next steps in funding, while the marginal ones have fallen away, which is the life cycle in ventures. It's good. It's sort of a tree dies in the forest, it becomes part of the ecosystem. But the best opportunities I see right now are really across what we refer to as enterprise, which is, I like to say, it's everything that touches a business, from software, B2B, services. The world has proven that software is king, that we live in this cloud-based society now, where you're working from home, your corporations are pulling far more data from the cloud, which is a principal theme. And Downing, we're very much thematic investors, focused on these core areas. The opportunity sets to support these are, growing at what I perceive to be a generational opportunity to invest there. Outside of enterprise, we focus on deep tech, which is lovingly referred to as about 3 to 5 years from revenue, but very intellectual property heavy businesses that are working to address problems or challenges in the future to take technology another step forward. I'd like to say there, for us in deep tech, what it really means is there's been a proof of concept, there's been a proof of value, there's a demonstrated commercialization that will be taking place, and that our capital is an accelerant for that to happen. Outside of that, we look at healthcare. We have an exceptional team there that focuses on all the interesting sub-verticals there, such as drug discovery, digital health, devices. Because of COVID, there's every investor in the world is looking at healthcare and how to solve these problems that have been created. So I think that the overall sector focus is very applicable today.
Other than money, what do you add as an investor to the companies you invest in?
That's a great question. So, I have this talk all the time with the team, that I tell everybody that just because you have money to invest, it means almost nothing, because money is everywhere. London is basically paved, with sterling and gold. To set yourself out as a venture capitalist, set yourself apart as a fund manager, you have to be able to holistically address all of the things that go into making a successful company, which is number one, what are you offering these companies? For us, it's helping them with sources of, say, non-dilutive funding, grants, using our corporate network to help accelerate business development, working on things such as mundane as hiring, helping them identify top talent for CFOs, COOs, or otherwise. Other areas we add value is simple things. Like we have an operating partner we're very proud of, that he looks at sales and business development. He was brought up at Salesforce. He looks to address a lot of these problems in early stage companies. It's the whole argument, they don't know what they don't know yet. And so helping them codify business plans, sales strategies. And otherwise, it's really just, what are we able to do that will accelerate this as a one big view, because the money is oftentimes the easiest part of that.
What about successes? Have you had any exits recently?
So there haven't been any exits recently, and I think COVID kind of slowed things down a little bit. But I'm happy to say we've got a few things that are very close right now, and I think that'll be something we can talk about next.
And how risky is the VCT now? In terms of VCTs are risky, you've moved from sort of older style companies, possibly more secure to something, a much more racy world.
Yeah, I mean, that's interesting, right? I find the VCTs to be fascinating. I think that when they're managed well, you get exactly what an investor would want. You have some of the very stable, dividend payments, you have a variety of things. But in my world of ventures, I look at it entirely different. I think that, in the early days of VCT and EIS here, there was a big push to invest in early stage businesses, seed, maybe even before seed. We take a far different approach. And, risk awareness, I think is, what do I add value to Downing? It's really risk awareness, risk quantification. And so we address this through an approach that's wholly different. We feel to a lot of our competitors that we're truly a multi-stage investor. We're truly looking across from Series A to we've executed a Series D lately, which are, much more mature companies, which gives a portfolio a much more balanced effect. That these later stage companies are, producing significant revenue. They're on their way to break even. They're on their way to generating cash flow to a natural exit that will occur. And then as you move, closer to the early days, you're getting those big step ups in valuation. That when you do your homework right, your A to B multiple gain will be quite noticeable. What we have done though is really quantify the risk, across the entire ventures book, and saying that, both my personal macro view is that this is the wrong time for seed investing. My personal view is that we've had this massive uplift from 2015 to 2018, where the multiple growth of the surviving companies was huge. And it makes me think that that's going to slow down a lot. And the real, those who survive the A opportunities, the B opportunities, and those series will be far better. To that extent, I'm very, very data driven. Very not the best communicator, so I like numbers. And when I look at the charts and I see a massive amount of fundings and where they have gone is UK-based businesses as a whole, so in ventures. And you see that the biggest slug of capital to be invested in these businesses is Series B and beyond. And that tells you that there's a sea change in the market. And that tells you that if you're chasing these seed opportunities or these very early stage opportunities, you're probably not going to generate the returns simply because the market has evolved away from that. And now, as the capital needs of those businesses accelerate, we can pay a meaningful part of their growth and development. And that's one of the ways that we're reducing risk. But, in ventures will always be risky. But again, we're sector focused, enterprise, deep tech, healthcare. And within that, we're thematically driven. For myself, it's what's going to be the next 10 years of the cloud? What's going to drive supercomputing, and how do we invest there? It's by knowing the market inside and out, to doing your homework, to invest in a proactive manner, not being reactive to deal flow, not being reactive to opportunities, not being afraid to say no, not being afraid to pass on things in order to pursue these things that we know will make money. And that's, this high confidence investing with these focused areas, I think is a distinct advantage, to keeping the risk in check and balancing with the rest of the VCT.
Finally, for people who are looking to invest in a VCT this year, why should they choose Downing One?
I mean, I think that there's a lot of reasons to invest, and I think the tear sheet reasons of you have a fantastic team, you have a lot of diversification, you have access to many different subject matter experts, you have a tactical investment strategy. But I think beyond that is that, speaking for myself in ventures, is that, I believe we're proving we're doing what no one else in ventures is doing well. That we're tactically focused along key areas, we're quantifying a higher quality of opportunity, and we're executing on things that drive meaningful innovation here in the UK by being far more focused.
Warren Rogers of Downing, thank you very much.
Thank you.